Since the beginning of October, there's a divergence between U.S. economic fundamentals and corporate earnings versus the market price action. When we look at the U.S. data, growth remains solid, and the recent midterm election results have no particular implications for the U.S. economic forecast. But more importantly, earnings from corporate remains to be very robust. However, the markets are very concerned, and investors are focusing more on the negative factors like higher U.S. interest rates, perhaps the U.S.-China trade tension, and maybe the lack of upside surprises from corporate earnings and forward guidance. The sell-off has led to higher than normal market volatility, but it is not uncommon to see a 10% or more correction even in years with positive equity market returns. As we approach the later stage of economic cycle, we do expect market volatility to remain elevated. While the current U.S. economic expansion is one of the longest in history, it is also the slowest, and this should naturally extend the current cycle. Going into 2019, we see further divergence in the global economy and less synchronized growth. U.S. growth will likely moderate back to trend, which is 2% growth, after the tax cuts benefits fade, and as the Fed continues to tighten monetary policy. However, U.S. economic backdrop remains solid, and we do not see any imminent signs of recessions in the next 12 months. However, more uncertainties in geopolitics and trade tensions are likely to lead to higher market volatility. The fund adopts a three-sleeve approach with static allocation into 1/3 U.S. high-yield bonds, 1/3 convertibles, and 1/3 U.S. equities with covered call strategy. The combination of these three asset classes offer an asymmetric risk-reward profile with potential upside participation during market uptrend and protecting more on the downside when market turn lower. When faced with market volatility, the strategy inherently has less volatility than a pure stock investment. Historically, high-yield bonds provide high income with less volatility than stocks, and whereas convertible bonds can provide potential income and capital appreciation, but with bond-like volatility. Lastly, the covered call strategy in the equity sleeve may reduce exposure to equity market volatility. For the month of November, covered call exposure in the equity sleeve has increased. When looking at U.S. corporate earnings trend, S&P 500 corporate profits have been accelerating since mid-2016. For 2018, U.S. companies continue to deliver strong results due to tax cuts. While the tax cuts benefit is expected to fade going into next year profit growth is expected to revert back to trend, but still positive at around 10% based on bottom-up estimates. Besides earnings growth remain healthy, high-yield defaults going into 2019 are expected to remain below their long-term historical average, and equity valuations have also improved after recent sell-off. Overall, risky market returns are expected to be more modest, but still positive. As the current expansion and bull market continue to age, we expect market volatility to remain high, although we are not forecasting an imminent recession. A multi-asset strategy like Allianz Income and Growth still makes sense, given its unique three-sleeve approach, which allow us to have the discretion to invest in the most appropriate part of the capital structure of a company during different market conditions. Almost any portfolio could benefit from income diversification, from lowering volatility to contributing to potential total return. The fact remains that many investors are worried about volatile markets and global uncertainty, and instead will seek more safety traditional bond investment that basically pay a low income and cannot keep pace with high inflation. And this kind of strategy is ultimately self-defeating, mainly because investors cannot achieve its income needs.
Allianz Global Investors.